What's up everybody? GenExDividendInvestor here. This is a super fun video for me because I'm going to tell you what my top 10 favorite dividend stocks are of all time. Ones that I own and recommend that everyone consider buying in their portfolios, assuming you can get them at a decent price. So if you like dividend videos like this, then I ask you to please hit the thumbs up button, subscribe if you haven't yet, and turn on that bell notification. So come on, please hit my button. That's what she said. Also consider sharing this video with a cool friend or relative of yours. Don't share it with uncool people though. I'll also tell you what some honorable mention dividend stocks are, and I'll share what I estimate the intrinsic values are of my top 10 to give you a sense of if I would be buying more at today's prices for my portfolio. So at number 10 I have a tie, and those are my utilities. Duke Energy, ticker DUK, and Southern Company, ticker SO. Two other awesome peers worth considering are NextEra Energy, ticker NEE, and Con Ed, ticker ED. As of August 10th, I own about 115 grand worth of Duke, making it my 8th largest position in my dividend portfolio, and I own 72 grand of Southern Company, my 17th largest position, both of which combine to give me about $7,200 in dividends every year. One of the things I like about utilities are their low betas. The lower the beta, the less volatility the stock has relative to the overall market, all of which helps lower my dividend portfolio's volatility. I like my growth portfolio to have larger betas to give it larger swings up, but in my dividend portfolio I prefer lower volatility to keep things as smooth as possible. While it's fun to call utilities the bonds of my portfolio, the reality is that they obviously aren't as stable as treasury bonds or something, though they still tend to lose less than the overall market when things crash. Another aspect of utilities I like is that their dividend yield tends to be higher than the market average. Duke is at 3.71% and Southern is at 4.07%. Both of those dividend yield percentages are low for them because their stock price relative to their dividend payout is higher than they historically normally are. And since dividend yield equals dividends paid in a year divided by stock price, a high stock price means lower yields. Here's an example of Duke's yield history showing it has slowly been trending down for the last 9 years. Utilities distribute a large amount of their earnings as dividends, and a long dividend history often implies stability and reliability. Duke has increased their dividend for 16 consecutive years, and Southern has for 20 consecutive years. What's amazing is that Duke has been paying dividends for 95 consecutive years. Their dividend went sideways for a few years after the dot-com crash. Southern Company will have paid a dividend to its shareholders that is equal to or greater than the previous quarter for every quarter dating back to 1948. Duke's payout ratio is around 75%. This payout ratio I'm showing is from FinViz, but they have a bug in their payout ratio. Unfortunately, no data source is always correct. Southern is actually at a 78% payout ratio. Another thing I like about utilities is that they're natural monopolies, which is nice from an investor perspective. Because of that monopolistic aspect, they have to be carefully regulated in order to protect the interests of their customers who don't really have a choice in using other companies to get their energy. One unique aspect of utilities is that they don't earn profits from the energy they sell. They provide energy at cost to customers to keep prices as cheap as possible. The way they make money is from investments in their infrastructure, like in their pipes, substations, transmission lines, etc., all of which is needed to provide their services. A risk to utilities is that the energy landscape is evolving rapidly, thus they need to ensure that they are adequately investing in renewables and other energy sources to continue to remain relevant and valuable. So a company like Tesla with their energy unit can both be a risk to utilities or could be a partner to utilities. Duke has a goal of at least 50% carbon reduction by 2030 and has a goal of net zero carbon emissions from electric generation by 2050. In 2020, Southern Company reduced greenhouse gas emissions 52% from its 2007 benchmark levels, exceeding its 2030 goal to reduce those emissions by 50%, and has a net zero greenhouse gas emissions goal by 2050. A downside to utilities is that their dividend hikes tend to be low, and we see that Duke and Southern's dividend CAGRs are in the low 3% range. Another thing to be aware of is that Southern Company has struggled with cost overruns from the construction of 2 new nuclear power plants. Anyways, let's talk about stock price now. A stock's price tends to oscillate around its business fundamental performance trends. So as things like earnings continue to grow, then stock price tends to follow, whether I'm talking about utilities or pretty much any stock. But in the short run, it's not uncommon that people's emotions and headlines can move stock prices well above or below intrinsic value. Thus, always try to do your buys when a stock is below its intrinsic value. Currently, my 1-year intrinsic value estimate for Duke is around $80, so to me they are too pricey today. That being said, analysts have Duke's 1-year target price at $106. I put SO's 1-year intrinsic value estimate at $57, as compared to analysts who see them at $68. Analysts have both of them as holds right now. To keep this video relatively short, I won't go over revenue and earnings and debt trends and such, but if you're considering investing, then I recommend you dig into all their financials as well as their business strategies, etc. Okay, moving on. My 9th favorite dividend stock of all time is 3M, ticker MMM. I know, I had 2 stocks at number 10 on my list, so 3M could be my 8th favorite, but I'm treating ties as one. Additionally, I'll call out Caterpillar, ticker CAT, and Lockheed Martin, ticker LMT, as honorable mentions in this range of favorite picks, even though I don't own LMT. CAT is actually spiking on the day I'm making this video due to the massive infrastructure bill that seems like it will pass in Congress. That should mean massive funding for roads, bridges, the electric grid, rail, etc. Thus, companies like Caterpillar stand to benefit. Back to 3M. Technology and innovation are at the heart of 3M, and they've been granted over 100,000 patents, and they get thousands of new patents granted each year. They have so many amazing products they sell worldwide, including their popular Post-it notes, and these days their 3M masks are flying off the shelves. I own 108 grand of 3M, making it my 11th largest position in my dividend portfolio, and it pays me about $3,200 a year in dividends. It currently has a dividend yield of 3% and has an amazing 63 consecutive years of dividend increases, along with a 7.75% 3-year dividend CAGR. It has a healthy payout ratio at 57%. My 1-year intrinsic value estimate for 3M is about $205, so I think it's a bit pricey. Analysts put it at $207 1 year out, and they have it as a hold right now. Okay, moving on. My 8th favorite dividend stock is JP Morgan Chase, ticker JPM, though others I really like include Goldman Sachs and pretty much all the Canadian banks. I stood on the sidelines for a long time getting into JPM, but finally did and have had great returns in a relatively short time frame. JPM has the largest market cap of any bank in the world and is led by the charismatic billionaire Jamie Dimon, chairman and CEO. I own 71 grand of JPM, making it my 18th largest position in my dividend portfolio, and it pays me about $1,800 a year in dividends. It currently has a dividend yield of 2.26% and has an okay 10 consecutive years of dividend increases, along with a great 16.4% 3-year dividend CAGR. It has a nice low payout ratio at 24%. My 1-year intrinsic value estimate for JPM is at $180, and analysts have it at $172, so I'm more bullish than they are, and they have it as a buy. Okay, moving on. My 7th favorite dividend stock is PepsiCo, ticker PEP, though I'll include Coke as an honorable mention at this point. Pepsi has done a great job diversifying their revenue beyond drinks to include awesome snacks like Doritos, Cheetos, and Ruffles. I own 119 grand of Pepsi, making it my 7th largest position in my dividend portfolio, and it pays me about $3,300 a year in dividends. The general trend towards healthier living is a risk for Pepsi, but I think some people will always consume less healthy snack options, and Pepsi can attempt to mitigate that by adding other healthier products to their portfolio. It currently has a dividend yield of 2.78%, has an amazing 49 consecutive years of dividend increases, along with a nice 8.29% 3-year dividend CAGR. It has an okay payout ratio at 69%. My 1-year intrinsic value estimate for Pepsi is at $135, and analysts have it at $167, so they are more bullish than I am, and they have it as a buy today. Okay, my 6th favorite dividend stock is Procter Gamble, ticker PG, though I'll include Clorox, which I don't own, along with Kimberly Clarke and Colgate-Palmolive that I do own as honorable mentions. My family uses PG products every day, including Tide laundry detergent, Cascade dishwashing soap, Bounty paper towels, and Gillette Mach 3 razors, to name just a few. I own 109 grand of PG, making it my 10th largest position in my dividend portfolio, and it pays me about $2,680 a year in dividends. One of the risks I see for PG is if Amazon can continue driving down prices for its generic competitive products. Procter & Gamble currently has a dividend yield of 2.45%, has an amazing 64 consecutive years of dividend increases, along with a low 3.92% 3-year dividend CAGR. It has a good 56.9% payout ratio. My 1-year intrinsic value estimate for PG is at $116, thus I think it's overpriced, but analysts have it at $159, so they are more bullish than I am, but they still have it as a hold today. My 5th favorite dividend stock is Realty Income, ticker O, a triple net lease real estate investment trust. I own 91 grand of Realty Income, making it my 14th largest position in my dividend portfolio, and it pays me about $3,680 a year in dividends, or about $306 a month. REITs often have higher yields, and sometimes they pay monthly, like Realty Income. REITs are a great way to gain ownership of real estate without having to deal with tenants or maintenance or liquidity issues, or etc. There's also some unique tax implications which come with REITs, so dig into that. I've really loved how Realty Income has held up so well in the pandemic. In July, they collected over 99% of their contractual rent across their total portfolio. It currently has a dividend yield of 4.04% and has an awesome 26 consecutive years of dividend increases, though it only has a low 3.4% 3-year dividend CAGR. As most dividend investors know, payout ratio and PEs aren't ideal to utilize for REITs, so instead you look at funds from operations or FFO, but I won't go into that for this video. My 1-year intrinsic value estimate for Realty Income is about $66, as I think it's overpriced, but analysts have it at $77, so they are far more bullish than I am. They have it as a buy today. Okay, my fourth favorite dividend stock is McDonald's, ticker MCD, and a few others I like include Starbucks and Home Depot, both of which I own, and Lowe's and Hormel, neither of which I own. McDonald's is one of those stocks that I'm confident will continue on through the generations. In poor markets it does well, and in good markets it does well. It's also considered a real estate play to some degree, as they own and lease the land the restaurants operate on. It's one of those companies I can never get enough of, and I've loved their products since I was a kid. I have 96 grand of McDonald's, making it my 12th largest position in my dividend portfolio, and it pays me about $2,115 a year in dividends. It currently has a dividend yield of 2.21% and has an amazing 45 consecutive years of dividend increases, and has a strong 9.58% 3-year dividend CAGR. McDonald's has a good payout ratio of 55%. My 1-year intrinsic value estimate for McDonald's is about $205, as I think it's overpriced, but analysts have it at $270, so they are more bullish than I am, and they have it as a buy today. Moving on, my third favorite dividend stock of all time is Johnson & Johnson, ticker JNJ, and another I like as an honorable mention is AbbVie, ticker ABBV. J&J is a stock that is number one in many dividend investors' portfolios, and they have many products that my family has used for generations. A risk to J&J are all the various lawsuits they're engaged in, but they've weathered the storm in the past, so I'm confident they'll continue to move forward. I own 156 grand of J&J, making it my third largest position in my dividend portfolio, and it pays me about $3,816 a year in dividends. It currently has a dividend yield of 2.44% and has an amazing 59 consecutive years of dividend increases, along with a decent 6.23% 3-year dividend CAGR. J&J has a solid 61% payout ratio. My 1-year intrinsic value estimate for J&J is about $160, as I think it's a bit overpriced, but analysts have it at $173, so they are more bullish than I am, and they have it as a buy today. That being said, J&J is a stock that I'm usually happy to dollar cost average into at any time. Speaking of AbbVie, it's a dividend stock which has done very well for its shareholders, and is a rare mix that has both growth characteristics along with a high dividend yield. The reasons for this are primarily from Humira, their main cash cow, but also has some risks of generics eating into its profits. Now, before I get to my top two, I want to share some other honorable mentions which are sin dividend stocks in Altria, Philip Morris, and British American Tobacco. They all have great yields and have solid histories of delivering for their shareholders, especially Altria, but I feel the future growth of these types of stocks have even more hurdles than they historically have had. And even though I own multiple of them, I couldn't include them as my personal favorites, though man, they pay out a ton. Sin stocks are a staple of most dividend portfolios, but I'm not sure they'll be as strong decades from now as they are now, even though I'm confident they'll still be here. Oil stocks are also good candidates for most dividend portfolios, but while their yields are great, I don't see them flourishing for my great-grandkids like my other stocks will. Okay, onto my top spots. I actually have two stocks that tied for number one in terms of my most favorite, and those are Microsoft and Apple. I've owned Microsoft the longest and thus have had the best overall returns with it, but even holding Apple only 2.5 years have given me over 275% returns with it. I own 225 grand of Microsoft, making it my second largest position in my dividend portfolio, and it pays me about $1,760 a year in dividends due to its low yield. I own 253 grand of Apple, thus it's my largest dividend position, and it's crazy to think that I own over $250,000 of Apple, and it pays me about $1,529 a year in dividends due to its very low yield. I consider Microsoft and Apple as the two crown jewels of my portfolio, and they both happen to be above $2 trillion in market cap. Both companies are just incredible and have delivered amazing total returns for their shareholders. If you don't own them, then I'd say get in once you find a price you like. Microsoft has a dividend yield of only 0.78%, and Apple is even lower at 0.6%. Their stock has been on fire, keeping their yield low. Microsoft has 19 consecutive years of dividend increases as compared to 9 for Apple, both of which are pretty good for tech companies. Microsoft has an awesome 27% payout ratio with a strong 9.1% 3-year dividend CAGR, as compared to Apple at an awesome 16% payout ratio and a 9.8% 3-year dividend CAGR. I've always found it challenging to value tech companies properly, so take that for what it's worth. Thus, I'll just say that analysts have Microsoft at $325 and they have it as a buy today. Analysts have Apple's one-year target at $165, also at a buy, but in my opinion both of these estimates are too rich. But hey, it's tech, anything could happen. Long term they are must-haves in my opinion. Regardless of what stocks you end up owning, I recommend that you follow what's happening to your companies and in the market. I'm someone who likes to see how earnings reports go, as well as I read all the business news coming out, from new products to lawsuits to whatever. If you're on my free Dividend Discord, you would see me sharing business articles all day long as news comes out. I found it very useful as an investor to be aware of what's happening, even though I've also learned that you need to be careful to not overreact to headlines. Companies that are strong today can die on the vine. Look at what happened to Sears, Blockbuster, Borders Books, Pan Am Airline, or heck, at one point in time General Electric was considered a must-have for most dividend portfolios. But the 2008 financial crisis nailed GE. They eventually slashed the dividend multiple times. So follow your companies to ensure they stay relevant and are constantly evolving where needed. Finally, my list does not mean that these are the only great dividend stocks. There are lots of other great dividend companies I like, including Target, Stanley Black & Decker, Walmart, Illinois Tool Works, and the list goes on and on. I'm just sharing my personal favorites in my dividend portfolio, and of course there are growth stocks I feel are worth owning as well. Speaking of portfolios, I wanted to share some news which is that M1 has raised their referral bonus to $50 when new people open an account per their requirements. I'm not sure how long this will last, but if you don't have an M1 brokerage account, then the way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500, deposits which need to happen within 30 days of you opening the account. Then you need to keep your initial deposit inside the new account for 30 days from the date of deposit to get the free $50. It's honestly free money, so consider starting that new growth or dividend portfolio that you've been thinking about. Now I'd like to shout out my latest Patreon aristocrats who have recently signed up. So thank you Burmart, thank you Kimberly, thank you DJ Bertrand 5, thank you Guy Gas, and thank you JT. As Patreon aristocrats, they gain access to my dividend portfolio tracker spreadsheet, which I use in this video, and they gain access to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I use for my new videos. If you appreciate this video, then please kill that thumbs up button, subscribe if you haven't yet, and click that bell notification. I highly recommend that you join my free Dividend Discord investing chat server, which has thousands of people on it and is growing all the time. It's a great and free way for you to directly interact with other investors and wannabe investors. Thanks for watching and clicking that like button, stay positive, and I'll talk to you again real soon.
I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.